Hi, I'm Jenny Brown and welcome to our weekly buy-to-let mortgage market update. I hope you're well. All fine here. Just ploughing through the many mortgage applications that we have coming in. It's very busy at the moment with the stamp duty holiday and deadline looming. Which is good actually. We wouldn't want to be quiet. The devil makes work for idle hands and all the rest of it. So and actually, the lenders have been really busy as well in the last week. So I've got lots of news for you to share, both regards to lenders' movement and also the wider market today. So without further ado, first up with the lender changes. So first of all, Vida Home Loans have made changes to their product range with the aim of slowing down business and allowing them to manage their pipeline of cases. They have been absolutely inundated. Vida lend on both homeowner applications and buy-to-let. So they've really felt the force from both sides there. So the first measure that they have taken is they have removed their 80% loan-to-value buy-to-let products. And they have secondly increased the minimum loan size for all buy-to-let and incidentally residential cases as well to £150,000. They've also, just as a point of note, removed all purchase products on residential mortgages with a view that they're only going to be doing remortgage applications going forwards. And I think really the point of doing that is just to ensure that anyone who is looking for a completion pre-stamp duty holiday deadline, they can't guarantee their timeframes for these guys, so they're only taking new remortgage applications on the residential front. So that's indicative of how busy some of the lenders are at the moment. Now, conversely to this, LendInvest have made some changes to their product range. Now, what they've done is, first of all, made some rate reductions for 70% and 75% loan-to-value 2-year products. Their rates now start at 3.19%. They've also introduced a new 5-year fixed product at 75%, with rates now starting at 3.54%. They've also reintroduced their Tier 2 credit criteria for buy-to-let applications. And what this is really aimed at are those with minor and historic adverse credit. So what they're saying is that they can accept applications from people who have had up to 2 defaults in the last 2 years, 1 CCJ in the last 2 years. Now, I would say this is limited to a maximum of £5,000. It does need to be satisfied. They can also accept 1 missed secured payment in the last 3 years, and by secured that means a mortgage essentially. They're also saying on their Tier 2 product range they're ignoring any missed payments on unsecured borrowing, so they're kind of reopening their doors up to those with some historic credit blips, which is great to see. We've also seen in the last week, it's quite a lot of these, sorry, the Cumberland has consolidated the number of holiday let products it offers, and they now have rates starting at 3.54%. They've also reduced their minimum property value to £100,000, down from £125,000. We've seen West One introduce 2 limited edition 5-year fixed rates, one at 65% loan to value and one at 70% loan to value. Now, the maximum loan on these products is £500,000 and their rates start at 3.39%. Now, in terms of West One, they're very much in the more specialist end of the market. So they do lend to individuals, limited companies and LLPs. They're also happy to accept portfolio landlords, no limit on the number of background properties in the portfolio. And they do take a fairly commercial view on historic adverse. So things which have really happened at least over 3 years ago. But actually, I think as importantly as that, what they do is rather than credit score, so they just run the system runs an algorithm which essentially pops out a score for you and you simply pass or do not pass. What they do is credit review you instead. So they pull your credit file and review it in the round, which is really good for those people who are simply not passing credit scoring systems with other lenders. In addition, West One also accept ex-local authority flats with deck access and properties that have been owned for less than 6 months. So it's great to see that with their very good offering, they've brought in some more competitive rates as well. We've seen Landbay increase their maximum loan size by introducing 2 new specialist products with a maximum loan amount of £2 million. And these rates start at 3.35%. Now, Landbay are, again, like West One, more of a specialist lender, so they don't mind large portfolios in the backgrounds, limited companies, that kind of thing. But great to see them introduce these products. They also have on their 5-year fixed rates on these larger products, pay rate calculation. So what that means is that for the 5-year fixed rate, the rental calculation that they use will be done at 145 or 125% at the interest rate you pay, rather than the notional 5.5%, which means that you can generally borrow more pound of mortgage borrowing per pound of rental income that you're receiving. So that's good. We've also seen West Bromwich increase their completion fees. West Bromwich only lend to limited companies. Their products are very competitive. So it was no great surprise that they did this, because they were getting bombarded with business. Coventry have increased their 75% loan to value rates by 20 basis points. NatWest have conversely cut their rates by up to 84 basis points, and BM Solutions have repriced upwards. We have seen Kent Reliance for intermediaries expand its HMO and multi-unit block proposition to now include up to 10 rooms, bedrooms or units, which is really great news. And they're able to lend up to 75% loan to value, up to £3 million worth of borrowing on the smaller properties, so 1 to 6 bedrooms or units, and 70% loan to value to 1.5 million on the larger ones. Now, on the smaller blocks of flats and HMOs, 6 bedrooms, they're also able to consider first-time landlords, which is a really big thing, and this is where a lot of people come unstuck as a first-time landlord looking to get into particularly HMOs, but also multi-units. So Kent Reliance can consider first-time landlords on these smaller properties, and they're also able to lend to individuals, limited companies, no limit on properties in the background. Same thing again, so that's really great news. Lastly, this week, we have seen Metro Bank announce that with immediate effect, and this actually came out late last week, residential and buy-to-let customers who are on or have recently been furloughed or are receiving any associated COVID-19 related deductions on their salary or income will not be accepted at over 70% loan to value. And what they've gone on to say is for self-employed people, this includes any SEIS grants received in the last 6 months. So lots of news from the lenders this week. Now, there's quite a lot of other news stories to get through today, but I think this one is probably the most pressing one to share with you. So Hackney Council has become the first local authority to outline that home buyers will be unable to complete their local authority searches before the stamp duty holiday ends on the 31st of March. And this is according to the Times. So as a result, home buyers are being encouraged to take out insurance against their deals failing to complete before the end of the stamp duty holiday. Now, Hackney has informed buyers that indemnity insurance is needed and prices for this start from £30. Now, what we're hearing is that due to a backlog of demand, numerous local authorities are taking up to 125 days to complete search requests for home buyers. The total number of stamp duty land tax transactions in Q3 2020 was up 68% on Q2. And this is according to the HMRC quarterly stamp duty land tax statistics. Now, obviously, this is very much linked to the stamp duty holiday, but I think really the message is very much here. If you are looking to complete on a purchase within the stamp duty holiday timeframes, it's worth understanding the parameters that the local authority who will need to be offering the searches up are working within, and speaking to your solicitor to ensure that if they're running to a tight time frame or indeed aren't going to be able to maybe meet that you are able to take out some kind of insurance policy to protect yourself in the event of missing the deadline because of this. Some good news now. The Green Homes Grant, so this is the grant under which landlords can apply for up to £5,000 to improve the energy efficiency of their properties, has been extended. The Green Homes Grant scheme was launched in September and it was due to end on 31st of March 2021. But as part of the new 10-point plan for a green industrial revolution unveiled by the government this week, this scheme is now being extended to March 2022. Now, in terms of what this means in practice, as part of the Green Homes Grant scheme, landlords can apply for grants which are issued as vouchers and cover up to 2/3 of the costs available for specific measures. Now, the extension means that the vouchers will be valid for 3 months from the date that they are issued, or until 31st of March 2022, whichever is earlier. And vouchers have to be redeemed before the validity period ends. An extension of your voucher can be requested at any time before your voucher has expired, unless the scheme has been closed. Now, also it's worth noting, and we mentioned this a few weeks ago, that as this year, all rental properties, other than those with valid exemptions, must have an EPC rating of E or higher, to be legally rented out. Now, coinciding with the launch of the Green Homes Grant in the summer, the government also announced plans to raise the minimum EPC standards for rental homes to grade C or higher from April 2025 for new tenancies, and again, unless you have a valid exemption. The government is also currently consulting on the proposals, with the cost cap proposed for landlords to be £10,000 to be able to access the exemption, which is much higher than the current £3,500. Under the proposals at the moment, all landlords would need to hit the targets by 2028. So with this in mind, there's a Green Homes Grant available for you and an EPC minimum standard coming up in the future. Probably worth looking into this a bit further. I'm certainly going to be doing it. I did actually start filling out a form on the government website. But actually what I found when I looked at this is that you have to have decided what work you want to have done and got quotes before applying for the grant. So you really need to first of all get your, it needs to be a trademark builder around to consult with you on the property, what you can do to improve things, and then apply for your funding after that. Crystal ball time, house prices. So I was reading a report from published by a company called Really Moving, and they were talking about a forecast for house prices to the end of the year and also into next year. Now, where their kind of minds are is that the housing market is on course to peak this Christmas, with an average house price in England and Wales forecast to hit an all-time high of £342,000, 511 in December. But the new year will herald the start of the anticipated readjustment. So their research predicts that price growth will remain in positive territory to Christmas, but start to run out of steam towards this point due to lockdown 2.0 and concerns over rising unemployment. What they're predicting is that in January, they are forecasting a dip into negative territory for the first time in what would be 7 months, of property prices falling by 1.2%. Now, what they're saying is that the trend is not of growth is not expected to continue into 2021, and they are expecting house prices to readjust downwards in the first quarter of 2021. So that's one business's predictions on price. I mean, I think it's fair to say that we would absolutely agree with their view on the house prices increasing to the end of the year. It's the bit about next year, which I think is in the balance for some. As we've mentioned before, I think at Mortgages for Business, we're not really expecting a house price reduction, and that would be on the new highs, not pre-COVID levels, of up to 5%, with things bottoming out and starting to recover in early spring next year. A lot of this really does hinge on the rollout of the vaccines and how the economy starts to rebound. But actually, I think our prediction really does still remain, having read all of this, at 5% reduction in house prices as an absolute maximum. Just touching on the wider economy, because obviously this has a big impact on the housing market. So UK inflation rose slightly higher than expected in October, increasing to 0.9%, and that's according to the latest statistics from the ONS. The CPIH inflation, which is the ONS's headline measure, which includes owner-occupiers' housing costs, was 0.9% in October, up from 0.7% in October. So clothing, food and furniture made the largest upward contributions to the change in the CPIH 12-month inflation rate between September and October 2020, which were then in turn partially offset by downward contributions from recreation and culture and transport costs. Now, what people are essentially saying is that actually this is largely going to be attributed to the various regional lockdowns, the tiering system, and then obviously we've also had sort of a secondary lockdown, and lockdown 2.0 as well. Industry experts are essentially saying that the October figures aren't the sort of high jump we saw in September, but actually they are still an increase all the same. So actually that's really, really positive to see. Phew, that was quite a lot of news there, wasn't there? But I hope you found it interesting. There's always lots going on in the market, particularly at this time of year. It will start to quieten down as we go into December, I hope. So thank you so much for joining us. As always, we are so incredibly grateful for you taking time to come and hear what we have to say. If you do want to have a chat with us about anything mortgage related, do give us a call 0345 345 6788, or have a look at our website mortgagesforbusiness.co.uk. The website is full of information. It's got stamp duty calculators, mortgage borrowing calculators, interest rates, case studies, blogs, you name it, it's on there. So it's a really useful tool. Just as a point of interest, really, our website has around 12 to 13,000 hits per week. So lots of people are drawn to it because of the sheer amount of information that's on there. So if you haven't been for a look before, please do go and have a nosy. I'm sure you'll find it very interesting. So look after yourselves, and I will see you next week.